welcome everyone. We can jump in. Little agenda here, some introductions, backgrounds of Scott and myself, walk through kind of a day in the life, some opportunities, challenges we face, and then the skill set required to do the kinds of roles that get employed on teams like ours, as well as So let's turn over to Scott. Let's start with his background.
Okay, contrary to what Josh said, he's not really old, I'm old. I got my CFA in 1986. Worked for a long time at Principal Financial in Des Moines, which is a big life insurance and pension company. Then I worked at Members Capital, which is in Madison, Wisconsin, another big pension company. So most of my career was in the 401k industry, where we were managing mutual funds that went into people's retirement plans. So very long-term, fundamental, solid investment field. That's one of the biggest groups that populate the industry. Today I'm at Leuthold Group, and I guess I'll talk about that in the next slide. What Leuthold is. Been here about 3 years, and in between for about 5 years I taught at Whitewater. I taught security analysis and ran the applied investment program there, and I was also the faculty advisor for Finance Association, so this is all old hat for me. Love that. I always wanted to teach, and got a chance at Whitewater for a while. I always wanted to write investment research, and that's what I'm doing today. So as we get in more to our firm, I'll tell you a little about that. So I've been in the business for about, this is my 35th year.
Excellent. So you're in luck. You have the rarity. You have two people with teaching backgrounds actually being in finance today, which is pretty rare.
Just what you
So I did my undergrad at Northwestern University. I was a math and major. And at the time, I decided I was going to go on and get a master's, not in pure math, but in math education. And then started my career teaching at the high school level, math and economics. Mostly focused on AP statistics. My undergrad in math was very much focused on applied math and statistics, which has come in very useful ever since I joined the investment industry. So once I got in the investment industry, landed a job at Kenwood Capital Management, which is a quantitative asset management firm. So it's going to be pretty different than what we described from a fundamental asset management firm. A lot of the focus is on building models to predict securities returns and risks and construct portfolios, as opposed to really your traditional asset management role of reading 10Ks, 10Qs, meeting with company management. So given my background in math and statistics, was able to get a job in finance that way, coming from math teaching. And then went the traditional route, got an MBA and CFA. After Kenwood Capital closed in 2009 after the financial crisis, had a couple roles in asset allocation and a director of research for a consulting firm. But now I'm at RBC Global Asset Management. And when I was initially asked to do this presentation, I was running the investment risk team and the performance team, which are very much research roles, though independent from the investment teams themselves. As of a couple months ago, I've switched roles. I now run our product function, product development, product management. So if you see on my business card or my title somewhere, was head of product, you'll think, oh, that's kind of funny that he's talking about a director of research, he's running a product team, which usually is a very different background, distribution, marketing focus. But really, until the last couple of months, spent my career with research type roles, either in a quantitative setting or providing risk oversight to fundamental teams. As I said, I've been involved in the CFA Society Minnesota for about 10 years. I've been on the board, been chair of membership committee, vice president, and now immediate past. And just have a short stint left in my term, and I will have to go off the board at that point, no matter what, or self ourselves. All right, so on to the next slide. A little bit more about our firms.
Okay, Leuthold Group is a firm that's kind of distinctive because we have two different business lines, buy side and sell side. Research origination is a sell side issue, which is we write investment research that's read by mutual fund managers, pension fund managers, big investment production folks. So we're writing monthly pieces, weekly pieces, special reports. So part of our firm is geared at writing new ideas, originating ideas, and sending them out to people that want to read them and then maybe act on them in their portfolios. The other side is we're a buy-side firm where we manage mutual funds. We happen to run a quantitative platform, so we have different mutual funds that we manage. So we are, in that sense, we're consuming investment advice. On the first part, we're producing investment advice. Kind of a nice double feature. My previous firms were both buy-side firms at Principal and Members, fundamental firms doing company-level research, managing funds that way. So I've I've seen the industry from both sides, from a lot of different sides. Maybe the most interesting part about my career as it relates to just the general field is when I started in 1983, we just had a fund called the stock fund. There was no identifier on it, no description, just a stock fund. And then as the industry expanded, we started doing growth and value. We did small cap, we did international, we did quantitative. Now we have things like quality funds and low vol funds and momentum funds. So the industry's gone from just the stock fund to all these different versions. And as we get into this, I'll mention why that's so important for director research is how you manage the firm and how you manage the analyst is different based on what your philosophy is. So the industry's got a lot more complicated in the last 30 years, but again, that's been a lot of fun. Our firm at Leuthold is what we call a tactical firm. Our main focus is trying to understand market history, market cycles, rotating between groups that are succeeding and failing, trying to figure out what the conditions are today to see what should work well, what should do poorly in the conditions today. So our focus is really at the asset class level, at the market level. We don't produce individual stock recommendations. We're thinking more tactically, rotating as the economy and the markets change, what asset class do you want to be in, which one do you want to be out of.
Okay. So as I said, I work for RBC Global Asset Management. So RBC is short for Royal Bank of Canada. It's the largest bank in Canada, 80,000 employees worldwide, massive balance sheet. It is, I think, the 10th largest bank by market cap in the world. It's so sizable institution. Pretty much anything you can imagine that a bank would do, they do. You can get credit cards, mortgages, corporate treasury, you can get wealth management services, asset management services, you can capital markets activity out in New York, helping companies do M&A, issue stock, issue bonds. I work for the asset management. So like you heard it being earlier today, we're a manufacturer of mutual funds and institutional separate accounts. We manage fixed income securities, we manage equity portfolios, US, emerging, global, we do some alternative investing. We cover the gamut, especially for Canadian investors, where we are 64% of our assets are with Canadian investors. But we do manage assets around the globe. We have offices in the US, in Minneapolis, Boston, Chicago, Vancouver and Toronto in Canada, 2 offices in London and 1 in Hong Kong. But our investments are in countries around the world, both on the debt side, emerging market debt, global debt, as well as developed market debt across the globe, US, North American. Research at RBC, there's 2 main groups that do it. One is the people who sit on the investment teams. So the fundamental research analysts, because almost all of our teams, with the exception of 1 quant group in Toronto, are fundamentally mixed. They're your traditional asset management groups. They're looking at bonds, at stocks, by talking to company management, doing a lot of research on those companies, building cash flow models, things like that. So the research analysts are going to be helping support that function. The research analysts that sit on the desk really support the overall research of the firm, come up with good stock ideas, bond ideas, things like that. The research teams that I work with are outside of the investment teams. So as I said, my whole career has been in quant asset management, either quantitative investing directly as a portfolio manager, or doing tactical or quantitative approaches to asset allocation. So again, I don't really fit in with our investment teams. They're very fundamentally driven. But what my research team does is support those teams with either economic research or, more particularly, research on how to construct portfolios, including bet sizing, like how big of a positions do you take? Okay, you got 30 great names. You came up with 30 great stock ideas. How do you weight them? How do you build your portfolio? How do you think about factor exposures and things like that? We'll get to that on some later slides. But how do you think about some exposures you may have in your portfolio because you happen to all like the same type of company? I mean, an easy example is maybe everything in your portfolio after you're done with your work are tech companies, biotech companies, and other high growth companies. And you say, on any individual name, I love these, but when I build my portfolio, that's really susceptible to an overall market turn against technology, say, or against high beta names or high growth names. And so we help our teams uncover those exposures, help them determine what to do about them. We never suggest trade ideas, that's not how you do it. But it's to help them that once they come up, do their fundamental research, have their research analysts on their team do their work, help them actually construct the portfolio, manage the risk of the portfolio, and do proper bet sizing. And also with trades. Sometimes we'll help them with trading decisions as well. If they want to know proper timing, we can do some research to help them do that if their own analysts are not doing that. So there are people like my team in Canada and Europe as well. We try to position these teams across the firm so they're closer to the investment team. A lot of the roles are called portfolio engineering. You start to see that in job applications more and more in the industry. It really is talking about that, like the engineering of the portfolio, the design of the portfolio, not necessarily the individual security selection. So before we go on, questions for either Scott or myself about our firms or our backgrounds? And we'll get into actually big ones. Excellent.
To me, the focus of this whole story is philosophy and process. And an investment firm, the basic activity every day is to come up with profitable ideas for the portfolio. So if I was to ask each of you, what does a good investment look like? I'd probably get 30, 40 different answers. Some people are contrarian value, some people are growthy, some people are, I want to own the best businesses. Everybody has their own view. One doesn't work very good if you're coming into a meeting and the portfolio manager has to pick between 10 or 20 different stocks if we're all looking at it in different ways. So most investment firms will have a philosophy and a process they follow where they've decided this is the way we want to look at things. At Principal and at Members, we were a fundamental firm, which was basically understand the intrinsic value of the company, what's it worth to its owners, buy it at a discount. Pretty traditional. Today, both Josh and I are at quant firms which say, let's identify companies based on a set of characteristics that have historically been profitable and then develop our buy list off of that. But in either case, we have a philosophy that we believe is going to lead to good performing stocks or bonds. After you get your philosophy sorted out, then you have to have a process. How do we go find them? What kind of research tools do we need? How do we analyze them? How do we write them up? How do we decide which ones to work with? So as a director of research, my role would be, if you're all the analyst team, to get us all on the same page. We're all looking for the same kind of stock. Maybe it's a fundamentally solid, good quality stock with a high cash flow yield. We're all looking for that. We know how to run the tools. We know how to talk to management. We all come to the meeting with the same arguments and the same perspective, and the PM can make a decision. If we start coming in with different, I like this because it's a high yield stock, and you like this because it's a high growth stock, we're not going to get anywhere. So the director of research is like a traffic cop where the idea flow has to all fit in the same form, the same mindset. Here's what we're looking for. Here's what the PM values in the stock. Here's what we think works, and then get the team to develop those ideas. I mentioned the interesting part of my career as we went from just one stock fund now to 20, 30, 50 different flavors of stock funds. Each of those has a different philosophy and process. So a value fund is going to look for one kind of stock, a growth fund will look for something different, a quality fund will look for something different. So in a multi-product firm like Principal, the director of research has to herd the analyst in about 20 different ways. So I've got one team that would look at, that are full of value, contrarian, bargain seekers. I've got another team full of growth buyers. So the complexity of the industry is made managing the team much more difficult, but much more fun as well. Sidebar on that too, most people I find have a personal philosophy of their own, that you kind of know what you think is a good investment. I happen to be a value guy at heart. That's important as you think about your career. If you become an analyst, you really want to end up at a firm that has a philosophy that's like your own. Because if I'm a value player and I go to a high growth shop, I'm not going to be very happy and I'm not going to probably be very successful. So one of the things we put on our list of jobs is HR function. As a director of research, we have to find people that fit right. So if I'm looking for a value analyst, I want to kind of get somebody who has that natural bias. If I'm looking for a quant analyst, I need someone with good technical skills. So the firm will have an approach, maybe that each portfolio has its own approach. They have a process they follow, and the director of research has to get the analyst all on the same page. So they're delivering ideas in a language, in a format that the PM can actually act on and make the decision. So I think it's more fun to be in a large multi-style firm because you can eventually figure out where you belong. But again, I've been in all the different sides. It's just a fascinating industry. But again, matching up your personal view of what's interesting, what's profitable, what do you want to own with the PMs is really one of the keys to this job.
Yeah, so to echo one of those final points you made, that communication aspect, that interpretation to translation, is a key part of what a director of research does. Because usually you're employing people who either are extremely good at tearing apart balance sheets and income statements and all that, or are extremely quantitative. They're really good at modeling and code writing and spreadsheet manipulation. And those aren't always the people who can communicate their results or their analysis in a way that someone who isn't like them can understand, right? So we have quants who run their MATLAB code, and they pull data from Bloomberg, and they run models, and they come up with ideas, and they analyze, they do back tests. And you can't just necessarily plot that person down in front of a portfolio manager who's been doing this for 30 years and comes at it from a very fundamental perspective and a value orientation, and then hear about this very quantitative approach that they should use to manage their portfolios. So the director of research has to take that analysis and not only interpret it and translate it for a portfolio manager or for clients sometimes or prospects. A lot of times we'll get called in to talk about our research to a prospect or client that wants to know how we do our research. So to be able to explain it, to translate it, but also to have enough knowledge about research and modeling to be able to go back to the research analysts and really question the assumptions and really think about model error or where things could be very sensitive to an input or what's the error on our answer. A lot of times I'll have someone come into my office and say, hey, based on my modeling, whatever the answer is, 5.42. Okay, that's the number that was spit out of the model. But if we really think about the model, what it's saying, and based on the error on the assumptions that are going in, and the t-stat and all the statistical analysis we can do of the result, what the model's really saying is the answer is between 5 and 6. Somewhere between 5 and 6. It's not 5.42. That may be the number that was spit out. But that's not, there's not that amount of precision in a lot of the models we use. Now there are a few times in probably in your career, but in most people's careers, just a few times, where there are opportunities that are so statistically out of the ordinary that people can make entire careers out of them, like 2008 and 9. And if any of you read Big Short or things like that, where people with conviction, there was an opportunity presented that if you really went in with confidence, you were presented with a value opportunity, or in this case, an overvalued opportunity, like you rarely see in a career. Most of the time, what we do all day long, it's basis points. It's batting averages above 50%. It's you hope that your analysis leads to a little bit better performance, but there's a margin of error on that, right? There's very few times where you find that opportunity, either on a single name or in an entire asset class, that give you those career-making opportunities. The rest of the time, it's just really hard research, day after day, slogging through models and company balance sheets or quantitative models, depending on your approach. And it's always questioning those assumptions, coming back and saying, yep, I have a strong buy on, say, Apple right now. Why? What could go wrong? Always coming back to that analysis of, if I am wrong, what would have caused that? That's how I like my research people to think. Okay, let's say this is going to be up 20% more than the market over the next 2 years. What if it underperforms? What could have happened to cause that to underperform? Think about what those assumptions would be and plug those into your model. So to make you question those initial assumptions and think about, okay, what are the worst case scenarios? At RBC, another thing I want to agree with Scott on is that a director of research, it's really trying to take all of the disparate opinions that people have, all the research analysts, either because of something they found or their natural biases to types of investments they like, and collate that into one story, one approach, one philosophy, make sure you're all on the same page. At RBC, one of the things we really try to do is have all of our investment teams incorporate ESG, environment, social governance, principles into the way they manage money. Now, we don't tell them that they have to be a socially responsible fund and they can't ever buy a sin stocks. like either carbon, ones that produce a lot of carbon, or cable companies, or whatever, tobacco companies, whatever, some investments that are considered like sin stocks that certain investors won't buy. Our investors can always buy an opportunity where the return to risk for their client is the best, in their opinion. So if they find extremely cheap stock, even if it doesn't score that well on ESG principles, if it, as our fiduciary for managing our clients' money, is going to provide a very attractive return relative to the risk, they're not prevented from buying. But what we do think is that over a 3 or 5 or 10-year time horizon, that there is some risk information in that data. That a company that produces a lot of carbon, or doesn't treat its employees or suppliers very well, or is poorly governed, particularly the governance one, doesn't have good governance principles, they may have a great year, they may outperform, but there's going to be a lot of risk around those names. Regulatory risk that they lose employees or suppliers, that the government, like right now with Facebook, Facebook could lose a lot of value if the government comes in and says, you are not managing people's data properly. You don't have the right privacy controls. Things like that. Or governance, where it's a bunch of people who are the CEO's buddies, and the CEO is also the chairman, and the audit committee is independent, things like that. Not to say it isn't a good business, whatever they sell, but that presents a risk that we need to incorporate into our analysis. So we help all our investment teams approach it from a somewhat similar way. It's not identical, but there's a large part of that to a director research job, making sure that there's a company view on how we analyze investments and how we approach markets that is incorporated in all of the teams or portfolios or strategies where it's a little.
We comment a little bit on resources too. This is an industry where the data availability is just unbelievable. If you think you want to be an analyst someday, you've got to love reading, you've got to find data interesting, because that's what you do all day. But we have tons and tons of data. Part of the job for the firm and the director of research is making sure we've got the right resources, which means databases, news feeds. And again, there's a lot of them out there. It's an incredible industry for getting data. But maybe more important is flipping back to the notion of the philosophy. The PM says, this is what I think a good investment looks like. Most firms are going to come up with their own formulas, their own models to pull that data out of the database and decide which stocks make the top of the list. So if you're value, maybe you've got some cash flow metrics, maybe some growth metrics if you're growthy. If you're doing a style like quality or momentum, you've got to define what does that really mean and then suck the data out of the databases. So part of the process management is building the tools where we start with raw data and we end up with a list or a ranking of assets based on what we value or what we like in that asset from best to worst. So again, the DOR is going to do that, make sure that the tools answer the questions the PM wants, that the models are spitting out the right answers, manipulating the data right. But it's a fascinating industry for information flow. Now we've got companies that put out data. For example, they've trained computers using artificial intelligence to look at the wording in management reports and decide if it's optimistic or pessimistic wording. They have satellites looking at delivery truck routes for Walmart to figure out how much they're selling and what they're selling. So the data flow is just unbelievable to the point where the raw data is overwhelming and you won't get anywhere with it, but you've got to reformat it, re-engineer it to answer the questions you want to look at. But again, if you find kind of numbers and analysis and puzzles intriguing, it's a fantastic business to tackle that every day.
Okay, yeah, so one other final comment, and we'll take some questions before we go on to skill set things. I put a comment in here about attribution reports. I think this is one of the critical things that whether it's part of an investment team or an outside party doing this, is to run attribution. So attribution is saying, looking backward, what were my returns? And let me run some models on that and see where my returns came from. How did I outperform or underperform? And to tie that to the investment philosophy process. Did what I say was going to happen in my portfolio, the kinds of companies I bet on, does it actually show up when I look at my performance stream? And I don't want to say a lot of times, sometimes you will find that those are not tied together. So you might have a manager who says, I really love deep value companies, that are stable growth, but I really focus on valuation. My favorite metrics are cash flow, adjusted for a couple things, and there's a few characteristics I really like about companies. But you might run an attribution and find that most of his return came from a market factor like momentum, or that her performance was based more on growth companies, not value companies, that they at least claim to have a certain process. But when you actually look at their returns and the way companies are performing, it doesn't really tie to that. And that is concerning even if that manager is outperformed. Because if you've outperformed for the wrong reasons, one, the client doesn't know what to expect going forward. Like, well, you say you're a value manager, but value underperformed a lot, and you outperformed, and that doesn't really make sense to me. And so what's going to happen when it goes the other way? And it also might make the manager question what's going wrong with the process that would lead them to that result. So there is a lot of information that research analysts will do when it comes to attribution. A lot of our work is looking forward, right? What are good companies to invest in? Let's build some risk models as well, with tracking error, make sure our risk is within the tolerance we want it to be. But also making sure we do this attribution analysis consistently every quarter, every year, and saying, are our returns coming from where we thought they would? Now this is usually done when somebody's underperforming. You usually want to go and say, okay, why are you underperforming? We had a manager a few years ago who claimed to be a stock picker, bottoms-up stock picker. I don't take bets on sectors, don't take bets on industries. I'm a bottom-up stock picker. But quarter after quarter, all the returns were coming from sector bets. Like really all of the return could be attributed really to the either big underweights or overweights. They're being taken on sectors. And so that's a little disconcerting, right? You say you're a stock picker, but it seems to be coming more from your macro sort of top-down calls, right? That you're a sector bets. There's nothing wrong with that. If that's what the manager claims to be doing, like they say, I'm a top-down manager, I get my returns from sector bets. Okay, it shows us an attribution, great. You're doing what you said you would do. It's when there's a disconnect, whether it's outperformance or underperformance, that causes concern because then you don't know what's going to happen going forward given the market environment. It's much better for a client to walk into a client and say, we underperformed, but given the market environment, value underperforming growth, and I have value tilt, and I can show you an attribution that it came from that exposure, but you hired me to do this, and I told you that's how I manage money, and hopefully over long periods of time that philosophy outperforms. That's a much easier conversation to have with a client than coming in and saying, we underperformed, and actually I should have outperformed because I had a bunch of tailwinds from the market, but I made some bets over here that I didn't really tell you about, or you didn't expect from me. So underperformance with an explanation is okay, as long as it doesn't happen quarter after quarter after quarter. Obviously at some point you have to outperform and show performance. But the attribution analysis is something that's critical to the job.
This is maybe a spot for one of my pearls of wisdom from all my years managing PMs. I've found over the years, and I would say more PMs have bad performance because of bets they didn't understand they were taking than because of bets they knew they were taking. The bets we know we're taking, if we're skilled and well-trained and diligent analysts, they usually turn out okay. But PMs will make, it's not just clients, it's the PM themselves who doesn't understand their bets. I had one, for example, my best example is a small cap value PM who just had really bad underperformance and it was concerning, so that's when the management team gets involved and we talk. And I looked at it and I thought, all of his ideas, most of his ideas usually pay off pretty well, but he's still got bad numbers. What's going on? And we looked at it and we figured out he was getting in too early. So if you think about value, stock's up here, news is good, life is good, it tails off, gets down here, news is bad, price goes down. He was buying on the way down too early and writing it down before he ever made the real money on the upside, because a value investor wants to buy somewhere near a low and let things work out and come back up. So we said, keep doing what you're doing, but just pay a little bit more attention to your entry point. It's still value down here. Just let the story pan out. And again, in small cap world, you've usually got underfollowed companies. The news flow can get really bad and stay negative for a while. So let the story settle. Maybe even let it start to turn up a little bit before you get in, and you'll end up doing a lot better. So this whole notion of attribution is understand the bet, know what your bets are, and again, it all comes back to, are you doing what you said you were going to do, which is in this case, buy small cap value stocks. Is that what you're doing and is it working? Now, if you've got a process that just doesn't work, that's a whole other issue. But I've seen a lot of PMs blow themselves up number-wise because of bets they didn't know they were making. And again, that's just the value of a real robust, well-defined process and knowing what you're trying to accomplish and sticking to it. Staying on this slide a little bit, let me hit the hire and train since you guys are all in job-seeking mode or will be soon. I've done a lot of hiring over the years. And just want to give you a couple of thoughts on the hiring front, just generically. Hopefully you're all getting good grades, get the degree, pretty proud of that, but remember as you come into an interview with a firm, that's the ante to get in the door. What I'm really looking for when I hire somebody, and this I think is true in any job, any industry, is I'm looking for people that really want to do this, that like doing this. It just sounds like a lot of fun. And I kind of look for the person who would do the job even if it was free. They didn't get paid for it, just because I think it's so much fun. So what do I look for in an interview candidate when I see that? Well, I'm looking for somebody who has basically made an effort to teach themselves some of the field, to expose themselves to the field. Being in finance club, that's one thing that says you guys are interested in the field, you're kind of interested in the future. I'm looking for people maybe that read investment books, maybe they've even taken CFA 1. What I want is evidence that you're not just here looking for a job that's got a nice paycheck and a nice office, but you're looking to do something you enjoy and something that you've taken the personal initiative to start developing yourself, to teach yourself, maybe go to a conference like something like this. I'm looking for a dedication to the field at a personal level outside of the whole classroom story. So. Again, if you want to head toward the investment route, do things that indicate it's a fun hobby for you, it's a fun field. Read a few books, follow a couple fund managers that are famous and successful. Do things that tell the employer you're interested. Because in that interview, instead of talking about school and classes, they're going to say, well, they'll say, I follow the Oakmark Fund, and I think those guys are really on the ball, and they'll say, well, why do you think that? And off you go. I actually had an interview once. I happen to be a big fan of investment books and reading investment history. So the guy says, well, what are some of your favorite books? And I listed off 3 or 4 of them. And he kind of smiled, got up and went over to a closet and opened it. And one of those books, he had 200 copies in his closet, and said, I give one of these to every one of my clients. So that was a good interview. But anyway, so on the hiring front, if you can demonstrate that you're interested in the field, that you're taking a little personal initiative to make yourself useful to me on day one, if it's a quant firm like we both work at, maybe play around with some computer packages, maybe some online simulations. Just show me you're interested in looking for more than a paycheck, because that's going to be a good interview. Anything want to add there?
No, I think it's good. So before we move on, questions at all about what we talked about here, the investment process, team management, search and all, or research and all that I was wanting like here. Yeah, what book was it?
It was called Common Stocks and Uncommon Profits by Falk Fisher. It's considered maybe the first legendary book for growth investing. And it happened to be for a growth firm, so I didn't end up working there because I'm a value guy, but that was the book. If you're looking for a fun, easy book, well, again, there's the classics like Intelligent Investor. Security Analysis is a monster book. I don't know that one, you want to buy that and put it on your bookshelf to look good, but don't actually read it. The book I would recommend, again, for people that have too much to read and not enough time, the easiest weekend read book that's come out lately is a book by Howard Marks called The Most Important Thing. He wrote it about 7 years ago. And the title is, what do I think is the most important thing about investing? Well, it's got 18 chapters and they're all important, but easy, no quant, no formulas to memorize, no ratios, just good common sense. So if I was to say at your level, one book to read that's an easy read, it's easy, quick read, The Most Important Thing by Howard Marks is on my list.
And I really enjoy, I mean, they're not as much like how to invest, but books like Barbarians of the Gate or Smartest Guys in the Room or The Big Short, because I think in this industry, the biggest downfall for most investors is hubris, is overconfidence of thinking you know more than everyone else, and not even doing illegal things. Like it doesn't have to be Enron and actually trying to do things that portray their company in a light that isn't true or lawful. But even Barbarians of the Gate, the story of the KKR acquisition of Nabisco, Archer Nabisco in the 1980s, or any of these books that are great reads, they're going to tell you how to be an investor. But it's always helpful to be reminded that extremely smart people with CFAs and MBAs from Wharton or Harvard, who've had great careers, that they can too have either massive underperformance or get convicted of fraud or overpaid for a company because they don't go back and question their assumptions. They don't listen to other opinions. They don't hire a diverse team around them that's always asking, like, what could go wrong? What are worst case scenarios? And that is where in this industry, you can really not just destroy a career, but destroy a portfolio or cause underperformance. And you could have a bad year, if you're down 1,000 basis points or something, that will ruin your 10-year track record. And you've got a long time before you'll ever be back. And a lot of times it's not because of one big bet that you really had a lot of confidence in that, like the 2008 or 2009, where it was just blindingly obvious. It's just that hubris where you have some success, and you think you know it all. Well, you know what? The market has a lot of smart people all trying to find the value of certain instruments, and that value is probably pretty close to accurate. Now, you might do a little bit more work and find out something that no one else knows, maybe, but there's very few people that can really do that. But if you're diligent, you have philosophy and process, then over time, hopefully you're going to outperform your benchmark. But it's when you become too hubristic or think that you're smarter than everyone else in the world that with how rapidly this industry can move and things can change, you can never know. So some of those books are just, and they're entertaining too, right? The Big Short is just entertaining read. Barbarians of the Gate, Smartest Guys in the Room, many of those sort of famous books from the last 20, 30 years. But not, if you want to learn about investing, then the ones you mentioned are excellent. So, yeah.
This question is for Scott. You mentioned about the philosophy, process, and the control steps. And most of the times investors give you what they're looking for. They're looking for value, so that philosophy part is already predefined. So you're really presenting your process and control ability to execute it. In your experience, how much of clients are really looking for very prescribed, narrow investment style versus more or less like a constraint?
Okay, so the question is, let's assume I've got a client who hired us to run value. So the philosophy has kind of been picked by the client. Do you want a real detailed process, or do you want sort of one that's open-ended and flexible? I've spent a lot of time in the institutional world, which is where I would pitch my fund management to big professional pension managers. And the answer in that arena is they want a lot of detail. They want to understand what you do, what steps you follow, and at the end of the process, does your portfolio look like the process should kick out the names in the portfolio because the proof is in the pudding. So in the institutional space, they want a very clear understanding of what you do for a couple reasons. One is to decide if they think it's going to work, and two, to see if you're if you're distinctive, or what do you bring that other people don't bring. If I just come in and say I'm running PE screens and I'll buy the cheapest stocks, that's not very value added. So what I need to do is convince that client, not only do you want value, but my brand of value, my style of finding value is better than other people's, and I'm going to deliver a better portfolio. So in the institutional professional world, a clear, almost rigid process that kicks out a portfolio that you can recognize is pretty important. On the retail side, if I was just managing money for average mutual fund investors, they don't get very deep into that because they really don't understand it. So at the retail side, you're really pitching, why do you think value works as a philosophy? You're defending the philosophy at the retail side. And the institutional side, you're defending the process, because there's 300 firms that run value funds, why will they pick mine? And I've got to be very clear and distinctive on the process.
If I can ask a second derivative question to that, you mentioned a lot of move toward the quantitative, and that's when, based on quantitative model, it will give you a bunch of stock options, stock recommendations that are growth, tech. I mean, it's a mix of all, but how do you strike balance to clients, especially for institutionals? I have a really robust quantitative model, but it's not going to necessarily stay within value. It would give you all of the small, large value growth.
Okay, so a couple different angles there. One is, what about a quant model? And then the second question was, what if the quant model wanders out of the value box? I'll take the second one first and say, if your client has hired you to run value, you need to build a quant model that stays in value. That's not an option. If your quant model doesn't stay in value, you market it as an agnostic or a market-wide model. You never, as Josh said, you never want to surprise the client by bringing in a fund full of quantity growth stocks when they thought it was value. So the second part of the question should never happen, that the philosophy, the mandate, if we call it that, and the model have to match up. But both sides of the story have room there. If again, when I started, we were a value firm, we didn't compete for any growth mandates because we didn't fit the box. So that's important. In the quant world, quant is basically, again, characteristics like growth and momentum and volatility and things like that. There you're going to describe, you typically describe under what conditions will the model work best or will it work poorly. Value works best in certain parts of the business cycle. Momentum works best in certain parts. So in the quant, today at Leuthold, we run quant funds. We don't read any annual reports. We don't do earnings forecasts. We're looking for funds that, or for companies that fit a certain description of quant characteristics. So there, the proof of the process is our portfolio is full of stocks that look like we told you they would look. And then again, it comes back to defending the philosophy. Why do we think that set of characteristics works? And in the quant world, there's a lot of back testing and historical studies and professor papers on what works and what doesn't over time, and that's really the proof statement is, over time, these particular quantitative metrics have worked, therefore, we're going to bet on them working in the future, and we'll deliver the portfolio. But the investor and the manager, part of the process of hiring a manager is to get that fit, to make sure what I deliver as a manager and what you want to hire me for as a pension fund are the same thing. And if they're not, you're eventually going to part ways.
Other questions before we move on? We've got about 15 minutes left. Yeah,
Josh, I think this question is a little bit more towards you, but does your team make the investment factor calls? And then you go and tell the investment teams, these are the sectors or these are the buckets that you should be looking for new ideas. And then I guess my last question on that would be, are those suggestions or those marching orders within your organization?
So we do not tell our investment teams how to manage money. We never would do that. The only time where we can go in and tell them to stop doing something is if they've actually breached a mandate or an investment policy statement from our clients, where our client said you can go no more than 10% overweight a sector. If we find a portfolio manager who's 11% overweight, they have to correct that. We've contracted with our client and said we would stay within those constraints. And if for some reason they go above that, they have to correct it. That is the only time I can walk in, and usually the CIO is the one who's doing it, not me, can go in and say they have to correct something. When it comes to factor exposure and sector exposure, what we help the team see is how much risk that's creating and how it could produce returns that might be different than what our clients expect. So if we have a value manager who all of a sudden shows a very high momentum bias, say, that might be okay, it depends on how value stocks are doing, but we bring that to the attention of the PM and say, you're looking at companies all day long, you're buried in company management calls and meetings and reading documents, you may not have even been aware of this. So that's where our role is, to come in and provide that information. Usually they'll know their sector and industry bets, like they're pretty well aware of their overweight financials, overweight technology. But when it comes to momentum, volatility, growth, macroeconomic characteristics like GDP or inflation, interest rates, our job is to provide them the information. not to tell them how to use it. And sometimes they'll ask our opinion, and we can say based on research right now, it seems like being on the low volatility end of things is, it's kind of expensive right now. Not to say it can't continue to work, or maybe it's an extremely cheap place. We can provide that data, but it isn't our role to provide opinion. And in fact, if we start providing opinions, the less they'll listen to us in the future about things that are important. So I try to find people who are on my team who are content with that, and it's hard. It's hard to find people who really love the industry, like doing the research, but don't get to make the call that it actually happens. I happen to like these roles because I get to work with teams, or did until a couple months ago. I get to work with teams manufacturing equity portfolios, fixed income portfolios, real estate portfolios, alternative portfolios. I can see it all, whereas if you're a research person on a small cap value team, you're looking at small cap value all day long. Now, they also get to affect changes in the portfolio that is really intriguing to people, and they enjoy that. I try to find people who really enjoy looking at the entire landscape of investing, and are okay not making decisions, but getting to do fabulous research all day long, learn a lot about stuff, new information every day. So, rambling answer to your question. Other questions before I go on? Yes. All right.
Okay. Kind of picking up from Josh's last point, if you are in the business long enough to get into these management roles like director of research, chief investment officer, things like that, you just see idea flows across the whole firm. You're going to see the companies people are looking at, the industry stories, the macro stories. I think that's just a blast. One day I'll come in and I'll hear a story about airlines, and the next day I hear a story about tech companies, and the next day it's a new story. I just love the idea flow. Always looking for new techniques. Again, data's all over the place. If we come up with a little bit better way to screen for value or identify a turning point in growth rates, that's something we're looking at. So it's a creative issue. Always looking for new ways to make decisions just a little bit better. I happen to like training and teaching. I like hiring new analysts and showing them this is what investing's about. Here's what the firm's about. Here's the role you have in the firm. As director of research, you've got to get those professionals up to speed and, again, all on the same page, using the same tools, answering the same kind of questions so the PMs can make a good decision. And, again, you're impacting performance every day. If you've got a $10 billion fund and you outperform by 2% a year, that's a lot of money for those retirement plans. So big impact if you can get it done right. Challenges, the biggest one is pressure for returns. It's a results business, and if you've got a fund or a process or a style that's not working well, that gets to be very difficult. You have to try and get in and understand what's happening, why it's not performing well. Is it something we can fix? That's always the hardest part. And again, any management job, time pressure, multiple demands, there's a lot of things going on, and you typically end up focusing on problems instead of all the fun parts of the day. You come in every day, there's something that needs fixing or needs tweaking. So that's maybe the negative side. But I just love the idea flow in the industry, and every day is a new question, it's a new challenge. And to me, that's by far the most fun.
Just two quick items before we go to the next slide. The returns part that you mentioned. In the Morningstar universe right now, if you look at almost any asset class, large cap value managers, large cap core managers, small cap value managers, there's been research to show that if you're in the top decile right now for a 10-year track record, 95% of those managers in that top decile at some point in the last 10 years had a 3-year number, a 3-year return, it was bottom quartile. They were in the bottom 25% of the universe. And over the last 10 though, right now, they're in the top decile. So over a long period of time, they've shown fabulous performance. But 95% of them at some point, if you just looked at their 3-year, we're in the bottom quarter. It's gonna happen. No matter how smart you are, how good you are, markets aren't always rational, you're not always rational, things will go against you. Regulation happens, changes happen. You have to be willing to endure that, to study it. I like this, innovation versus fad, also just what's cyclical versus secular, what's a long-term change, what's a short-term change. That, I think, is one of the hardest parts of the business. If you're underperforming for a couple of years, which everyone will do, is it your process that's just broken now, it isn't working? Or is it you just need to stay disciplined and eventually returns will go back to you because you have a process and philosophy that works. And in the heat of the moment, especially when clients are calling and asking, say, hey, 3-year number's not looking so good, your 1-year number's not looking so good, I know you got a good 10-year, but like, what's going on? It's hard at that time to know what to do. Do you stick with it? Do you change anything? Is there new innovations you want to adapt? Because the risk is you make a change right when the market's coming back in your favor, and then you don't capture the rebound. In fact, you start to underperform because different factors are in favor versus what was the last 2 or 3 years. So I think that is one of the biggest challenges about this industry. You get a scorecard every single day against your benchmark or against your goals or against some client expectations. And you have to be able to handle that pressure, to handle the fact that it can be not just a one-day underperformance, it could go on for 2 or 3 years. And you might lose some clients along the way. Even if you truly believe in your process, it will happen. Now, I know a lot of you, it's like when your parents say, oh, when you get older, you'll realize it. I mean, you're probably like, oh yeah, well, I'll always outperform. It's okay, don't worry. But it will happen to everybody. And then the last one is there's all sorts of innovations in this industry. Smart beta, multi-factor models, all these things that over the last 10 or 15 years have come in. And a lot of money is chasing that. Some of it is a true innovation and will last. It is a new approach to investing. And some of it may just be a fad, because there are fads, right? There's always some sort of thing that's in favor. You know, FANG stocks never go down until the last 6 months, and then you finally think they go down. Tech stocks will never sell off in 99, 2000. Mortgage, subprime mortgages are a great investment. Hey, they're AAA. Correlations are pretty low between all these different geographies. I can buy about the pretty low yields, no worries. There are plenty of things that happen in the industry that, in hindsight, we all say, oh yeah, that was totally stupid. But unless you can show that you really shorted it, at the time it's hard to know. And it's hard to go against the market, like Warren Buffett did in 98, 99 against tech stocks. It's hard to do that when a couple years later you still look wrong. So you gotta have a lot of fortitude and some, obviously, confidence in your ability without being too overcome. Any questions? Oh, did you want to add something?
No, go ahead.
Okay. Any questions before we go on to our last slide? We've got about 5 minutes left. Okay. There we go. Let's go too quiet.
I'm going to say the second one is the big one. And not only is it discovered part, it's the reason I'm in the industry anyway, is I just love every day to come in and ask the question, what's going on in the world? What opportunities is the market giving me? What looks cheap? Where am I being offered a chance to sell high, buy low? I just think if you're intellectually curious, you like puzzles, and now the problem is you have to be able to handle uncertainty because every day the rules of the game change and the playing field changes. So a lot of uncertainty, but incredible curiosity. Back to my professor days for a second. The most important thing I ever heard from alumni and people hiring students at Whitewater was this one. Writing and verbal skills is probably the place where students come out of college with the lowest level of skill that we want to see in the business world. So I just tell you, focus on writing and speaking. If your college has sort of a writing workshop thing and you're doing big projects, go there and get a little coaching. If you can write well and speak well, coming out of college, you're going to stand out because, again, frankly, that's the place we've done the worst. We can teach you formulas and all kinds of things in the book, but that's a way to stand out for the crowd.
Yeah, I would agree. We're always looking for intellectually curious, talented young people. You don't have to know a ton about finance, but if you have some good quant and analytical skills and show curiosity, you can get a job in this industry. Even if it's 5 years later, if you go do something else first and then come back to it, really just a good skill set, a good work ethic, curious about the world, want to learn, and can navigate spreadsheets and things like that. It's not like you can just read and write all day long. You have to have some aptitude in quant. The more you have, the more opportunities there'll be in the future, because there are a lot of jobs being created in the finance industry that are more computer science, programming, or technology related. 1/3 of all Goldman Sachs employees right now work in technology. 1/3 of one of the largest sell-side banks in the entire world work in technology and data. There will be jobs there. I know you hear about this industry in general that Analyst jobs are shrinking, pay is shrinking, revenue is shrinking because of passive and all that. And that's true. It's not maybe as drastic as you might think it is. But there still are jobs, and especially for those with some technical skills at any type of firm. Sell side, buy side, quant, fundamental, equities, fixed income. So it's really demonstrating those capabilities to get you in the door at these firms. It's not like trying to do rocket science after you've already been out of school for 5 years. You have to go back to school for that. You don't necessarily have to. Except to get the CFA. You do. All right, questions? Oh, did you have anything?
No, go ahead.
Sorry. Yeah. Questions for our last couple minutes? Anything we haven't answered yet? Yeah.
I've got a question. Do you think it would be a good idea to have or be comfortable with having multiple versions of analysis, like you said, quantitative or value or growth? Like, would it be good to have multiple spectrums of looking at it, or do you think to really hone in on just one way of looking at the market?
I think as an analytical exercise, it's good to have both. If you, and as an analyst, you can be somewhat flexible. I think once you get to the PM level, you've got how much you believe in. But as a new person in the industry, you should be comfortable with fundamental, annual report, number crunching, listening management, and you should be familiar with at least some version of a screening tool, a quant tool. So as a new person, you should be flexible. The farther you get up the decision-making chain, then you've got to decide where you're, as we said, when your numbers are bad, you can't sleep at night, you've got to trust your approach. That's when you need to kind of pick who you are. But early on, I think it's good to know. In fact, a good story from my past, I was a fundamental quant, or a fundamental guy all the way, value, looking at companies. Well, I had developed a sort of an unconscious bias. I never wanted to buy a steel company, an airline, or an auto because they're just crappy businesses, and they always will be. But every now and then they're interesting and profitable. So I just kind of mentally excluded them from my universe, but then I started playing with quant tools, just ranking companies. And every now and then they'd float to the top and force me to take a look. So in a way, having multiple disciplines will get you to look at new ideas, and that's good. But again, at the end of the, if you're where the buck stops, I think you've got to come down on one or the other.
Yeah. You mentioned books you enjoyed, but can you maybe talk about news sources or periodicals that you guys think provide
It's all fake. It's all fake news. Don't trust it. It's garbage. I don't know.
Just for following the industry, the number one website I would recommend is Morningstar.com. It's their free version. That's a mutual fund website, but it also has a section where they pull in 2 or 3 page commentaries from people like us that just feel like writing about stories. So I guess I wouldn't say necessarily follow the news flow, but follow the flow of thoughts and ideas. So Morningstar is one of those. Most of the big brokerage firms like Schwab and Fidelity will put out kind of thought pieces. Again, not 30-page white papers, but 2 or 3 page commentaries on the market. That's the stuff I would look for. And generally it comes from providers, either Fidelity, Schwab, maybe the big fund houses, like I can mention Oakmark or American Funds. Some of those places put it out. Don't waste your time too much on news of the day, but look for a flow of ideas of what's going on in the world and what to be aware of.
Can you touch on how you deal with economic forecasts, if that's done within your groups, or do you buy that third party?
So at RBC GAM, we employ our own economists. For GAM itself, there's also an RBC economist. We do have an economist who will make all sorts of forecasts and forecast anything you want. GDP in Thailand, retail sales in Bangladesh, doesn't matter. He'll forecast it, he'll give you a number. And it's useful. It is useful to hear the data that most analysts and investors don't necessarily look at day after day, because all he's looking at is economic data, building his chart models. And so it's useful, yes. But none of our teams are really top-down teams, and their sector bets don't tend to be so significant. They're going to say, okay, is our economist saying, what's he saying about tariffs because we're really concerned about steel price or anything. I'd say it's interesting to read, it's interesting to hear his thoughts, but how much does it actually impact investor decisions today? It's probably not very high. I don't know.
Yeah, I think if you guys have CNBC on in your finance lab or anything, you'll see a guy named Jim Paulson on a lot. He's our economist, one of the best in the industry. And we do a little bit of forecasting, but I'm going to distinguish between a forecast and what we do at Leuthold, which is more understand where we are today. Because we're big believers in cycles and cause and effect over time. And basically, if we can figure out where we are today, we have some days an idea of where things are headed next, either up or down. So forecasting, I don't think I've ever in my career managed a fund where we took a forecasting bet on it, but knowing where you are today is incredibly valuable. So that's where at Leuthold we spend a lot of time understanding cycles and where we might be in a cycle today, because sometimes that's really useful to figure out where we're headed next.
Scott has to, I should speak for you. I'll stick around for a little while. I think Scott might be here too. I know UW, you need to take off because you got to get to St. Paul and meet with NPR. Anyone else who wants to stick around for a little bit, feel free. But thank you very much for attending this.